Welcome back to Portfolio, everyone. And in this video, we're going over 6 high yield dividend stocks you can take a look at right now during this market downturn. So if you've finally seen some red in the market, over the past couple of days, there's been a sharp decline in market prices, and now may be a nice buying opportunity to jump in and get these high yield stocks. The tech sector has been on a massive run up and has been carrying the market. So now investors who are looking for some nice high dividend yield have to look elsewhere. So in this video, we're going over stocks in various sectors of the market. There are no tech stocks on this list. These companies are more of your stable, blue chip, cash cow companies. These are the slow growth companies that provide consistent cash flow to shareholders each and every quarter. All of these companies have at least a safe dividend rating, and none of these companies are at high risk of cutting their dividend anytime soon. So in this video, we're going to go over the 6 different companies, take a look at their dividend safety rating, their payout ratio, and all the other associated financial metrics you need when evaluating a dividend stock. This is going to be a quick overview of each and every company. And as you know, everyone, I am the Gen Z investor, and every single day we talk about different stocks you can buy, overall stock market performance, and any other big stock market news and headlines. So you can see here the market was in the red today. My portfolio dropped just about 2%, or at least $1,000 in value, currently sitting at $55,219. Overall portfolio is still up around 2.6%, close to $1,300. And most of my gains are still from the tech sector, but overall my portfolio has performed very nicely during this overall slowdown. We're going to jump right into the list, and the first stock, the first high yield stock you can take a look at right now is Duke Energy, currently being traded around $82 a share. This company has a massive 4.67% dividend yield, and with a slow type of high dividend stock, all you want is some consistent slow upward trend in share price over the long term, and that's what you're getting with Duke. 5-year performance up 21%, and that's taking into consideration the massive downturn they've seen since the month of March. So overall, a very slow growth utility company. If we take a look, current yield 4.67%, so a massive dividend yield on this stock with a payout ratio around 76%. So for high yield utilities, this payout ratio is very sustainable. Anything crossing over that 80+% payout ratio is getting on that high point, but for a consistent utility who has very, predictable cash flows each and every year, a 76% payout ratio is manageable. And they've been growing their dividend at a 3.5% annual growth rate over the past 5 years, which just shows that their dividend is kind of matching or slightly outpacing inflation each and every year, but not any massive growth on that dividend. And we're always going to take a look at Simply Safe Dividend's dividend safety score to evaluate how safe a dividend is. And you can see here, currently ranked 80, which is considered safe. Massive company with a $60 billion market cap. This is the first high yielding company yielding close to 4.7% right now. Stock number 2 on our list is American Electric Power Corporation. Ticker symbol AEP, $78 a share. Over the past 5 years, shares are up close to 50%. Once again, that takes into consideration the massive decline we saw earlier this year, where these shares have not yet fully recovered. So still up 50%, which shows this company has some nice long-term share price growth tied into a beautiful 3.5% dividend yield. And on the 52-week range, you can see here it's trading towards the low end, once again, which may make this a nice buying opportunity. If we take a closer look at that dividend, current yield of 3.5%, very sustainable payout ratio around 65% of earnings, and they've done a nice job of growing that dividend on average of around 6% over the past 5 years. So you're getting a company with some nice share price appreciation over the long term. They're paying a beautiful 3.5% yield, and this company has a sustainable payout ratio, and they've done a nice job of growing that dividend at close to 6% average over the past 5 years. If we take a look at their dividend safety score, considered very safe at a rank of 81, another large company with a close to $40 billion market cap. Moving on to stock number 3, this is a dividend investor's favorite, AT&T. Ticker symbol T, currently around $28 a share, another company where investors love it below that $30 price point. If we take a look at the past 5 years, you can see here they've continued to grow their dividend each and every year, but they have very little share price movement. Over the past 5 years, they are down 10%. If you take a look, they have been hit extremely hard from the month of March, and another company where they have not fully recovered and trading very low on that 52-week range. So these are companies where they haven't yet fully recovered. They haven't seen that massive growth past pre-pandemic highs like we see from a lot of tech companies or some growth stocks right now in this market. But these are the ones that are continue to pay out that high consistent dividend income. Current yield over 7%, which is absolutely massive. So usually you stay away from companies with dividends that high because they may be unsafe or inconsistent or be at risk of being cut over the short term. But this company, AT&T, so even though their dividend is up around 7% right now, their payout ratio is still only around 65% of their earnings, which is sustainable. They've done a nice job of growing their dividend for at least 25 consecutive years, and they have a beautiful dividend growth rate of over 2%, which just shows that they aren't really increasing their dividend very much, but your annual yield is matching the rate of inflation, which averages around 2% each and every year. And if we take a look at the dividend safety score, still ranked 65, which is considered safe. A mega cap company with over $200 billion market cap with a safe dividend score yielding 7%. This is very attractive to a lot of dividend investors right now. And for people who follow the stock long term, a lot of investors believe getting into AT&T below that $30 price point is a good deal. So it'll be interesting to see how this company performs. If they continue to do a nice job of paying off their nice long-term debt, we will follow along. This is a dividend investor's dream. Moving on to stock number 4, we have a different sector of the market. We have Pfizer, currently around $35 a share. On the 5-year chart, very slow growth, up only 13%, but slow, consistent, not a lot of fluctuation in share price, but you're getting a massive 4.23% yield. 52-week chart, they are trading somewhat towards the middle. If we take a closer look at that dividend yield, around 4.23%, very sustainable payout ratio of around 53% of earnings, and a 5-year dividend growth rate at 6.72%. So a very good dividend growth rate. So you're already locking in a 4.2% yield when you buy in, and then that yield is growing at a beautiful 6.7% each and every year on average. And if we take a look at their dividend safety rating, currently at 75, so considered safe, another mega cap company, low beta, like I mentioned, not a lot of price volatility, with a nice, safe, very fast growing dividend with a 6% yield. And of course, that dividend is not very fast compared to like an Apple or Microsoft who grow at double-digit yields every year. But for a higher growth company yielding over 4%, an average dividend growth rate of close to 6.5 to 7% range is a nice thing to see. Stock number 5 on our list today of some high yield stocks you can keep your eye on is Chevron. Ticker symbol CVX, around $78 a share. 5-year chart only up 6.8%. Of course, they have been hammered over the past couple of months, seeing a rapid decline. They have somewhat recovered, but still not trading anywhere near that pre-pandemic high. 52-week chart, once again, towards the low side with a market cap around $150 billion. This is another extremely high yielding company at their current price point at 6.45%. They've done a very slow growth in their dividend, yielding only 2.5%. And of course, in the sector of the market that they're operating, the entire sector has been destroyed. A lot of companies are going bankrupt, but Chevron is predicted to be one of the companies that will continue to operate, that can actually sustain through this tough time for the industry and actually grow. And this might be a nice time for the company because they can acquire, the assets of the smaller companies which are going bankrupt at a very cheap price. Their payout ratio is not shown here because they actually have lost money. They posted a net loss over the past 12 months, but I believe over the next couple of years, if this company can turn them back around, oil prices go back up, and this company can continue to post positive earnings, that dividend will continue to grow. And what kind of made me include this on this list is that their dividend safety score is still considered 65. It's still ranked safe, and Simply Safe Dividend actually reconfirmed that rating after their latest quarterly report. So this is a company where I kept my eye on. I wasn't planning to include on this list, but considering that Simply Safe Dividend still ranks that dividend safe, they've had the same rating since the month of March. Even during this market decline, when that whole oil crisis happened, Chevron reaffirmed that they focus on protecting that dividend. You can see here each and every month when the Simply Safe Dividends does their research, they reaffirm and keep it at that 65 rating. And that was once again confirmed on August 15th. So not much has changed for the company over the past few weeks. Moving on, the final stock on our list today actually has one of the highest safety dividend ratings on this list, currently yielding 4.2%, is Consolidated Edison, ticker symbol ED, around $72 a share, up on the past 5 years 19%, once again taking into account the massive decline we've seen over the past few months. 52-week chart on the low side, like all these companies have been, and with this massive 4.2% dividend yield, sustainable payout ratio for this type of company in the utility sector of around 72%. Another company where they are growing their dividend each and every year, just slightly outpacing inflation, but not a huge increase year over year. But with all these companies, these are more cash cow, slow growth stocks who we are okay seeing that 3 to 4% annual growth each and every year. 22-year dividend growth rate, and a 90 dividend safety score. Dividend safety score, very safe. The highest dividend safety score on this list. This is a company where it is extremely unlikely that they cut their dividend anytime soon. So this is one stock where if you're looking for a nice high yield right now, currently yielding 4.2% with a very safe 90 dividend safety score. So thank you for tuning in, everyone. Those are 6 high yield stocks you can buy right now on this market during this downturn. Let me know if there's any other stocks you want to buy in the comments down below. Thank you and see you in the next video.